In the alternate version of exercise 8-3, we're presented with a scenario where Rodriguez Company purchases real estate. And like you would expect if you purchased a house, it's going to include a combination of land itself, land improvements, so things like driveways, parking lots, landscaping, sprinkler system, fences, and also the building or structure itself. It's going to include a combination or a bundle of items. It indicates that the company paid $380,000 for the real estate plus $20,140 in closing costs. And if you think back to our scenario with our machine, we indicated any normal, reasonable amount paid to acquire an item and get it ready for use is part of the cost of that machine altogether. So it seems likely we would do the same thing with real estate, another type of plant asset. Closing costs, they're a normal, necessary part of purchasing real estate. So we'll add the $20,140 in closing costs to the initial purchase price of $380,000 to get a total amount paid of $400,140. You might think, well, this doesn't seem too hard. If I'm asked to create a journal entry, debit real estate, some asset account like real estate for $400,140 or property or something like that, and credit cash for the same amount and be done with it. The problem is that within this purchase, we're purchasing different types of items. And for example, some of these are depreciated and some of them are not. Land itself is considered to have an indefinite life. It usually doesn't succumb to wear and tear, obsolescence, and inadequacy. Buildings and land improvements and machinery and equipment, those things succumb to wear and tear, inadequacy, and obsolescence, but land doesn't. So if we lump this 400,140 into one overall asset amount, we'd be forced into deciding, do we depreciate it or not depreciate it, when some of those items should or shouldn't be depreciated. So we can't do that. And even if you ignore the land and think, maybe the relative value of the property itself or the land itself is insignificant, of those items depreciated, the land improvements and building, they probably need to be depreciated at different rates. So for example, things like fences or landscaping, they may only last 10 years, but the building itself may last 30 years or 40 years and have a completely different useful life. So what do we do? Do we average it out and say just depreciate over 20 years? That doesn't seem very accurate or reasonable way to allocate or depreciate the asset. So what we have to do is take that total amount paid of 400,140 and figure out some reasonable and systematic way of allocating it to the different types of assets, land improvements, and building itself. So we'll start to set this up. How do we allocate it? We'll allocate it according to the relative overall appraised value of each item on its own. So for example, if land was purchased on its own, if we could separate these out and it wasn't a lump sum or bundle purchase, and we could buy the land on its own, we would have paid $184,800. The land improvements, we would have paid $79,200, and the building appraised or would have been valued if we could purchase it on its own of $176,000. So if each of these items was purchased individually on its own, they would have been charged $440,000. That's just $184,800 plus $79,200 plus $176,000 for building. But because Rodriguez was willing to purchase them together, the net seller was going to bring down the price based upon that to $400,140. Again, I mentioned, how do we allocate that? It's according to the relative appraised value. So for land, how to come up with that percentage or relative amount of appraised value is take the land appraised value of $184,800 divided by the total appraised value of $440,000 is going to give us a relative amount of 42%. Land improvements, $79,200 divided by the same total appraised value of $440,000 gets us 18%. Building 176,000 divided by 440,000 gives us a relative percent of 40%. If we added these all up, we should equal 100%. 42% plus 18% for land improvements plus 40% for building. That's our total appraised value of 100%. Now let's take those appraised percentages, multiply them times the total cost of acquisition. Remember, that includes the closing cost too, and the total cost or amount paid is going to be 400,140. So land relative appraised percentage of 42% times the total cost of acquisition of 400,140 gets us an apportion or allocated cost of $168,059. Land improvements, 18% appraised value times 400,140 in total cost equals an apportion or allocated amount of cost of $72,025. Building, 40% times $400,140 equals a total apportion cost of $160,056. We want to add up the $168,059 allocated to land, $72,025 allocated to land improvements, and $160,056 allocated to building, and just make sure that we really have allocated that $400,140. Now, I know this has been a lot of work, but we still need to do the journal entry, so let's start building our journal entry. We identified that we're purchasing 3 lump sum items, including land for an allocated or apportioned cost of $168,059. We're acquiring land, which is an asset, so we're going to debit land for $168,059. Land improvements is going to be a debit of $72,025. And building is going to be a debit for $160,056. So again, we can't just debit property or real estate for 400,140. We need to properly allocate that amount amongst these different types of asset. We're still, however, going to credit cash for the total purchase price of 400,140.